Hi everyone, Lukasz Kalwak here from the Franklin Templeton Institute. This past week saw some serious rotation away from high beta assets, and fear is being spread on social media that the AI trade might be running out of steam or even on the verge of bubble burst. So today we'll examine the recent spike in market volatility and assess whether the weakness in technology stocks signals deeper structural issues or maybe just a temporary pullback. Let's start with the return of volatility. If you remember from our past updates, volatility is what we expected going into November. Just when almost everyone on social media was suggesting that we were heading into the two best months of the year, the Institute was cautious. Why? Because the market was extremely overbought. Fed members were cautious on December rate cut, and on the top of that, our indicators were flashing caution signals for November. The combination of these factors pushed the S&P 500 below its 50-day moving average, bringing a fresh wave of fear back into the market. However, this shouldn't come as a surprise. As I mentioned earlier, the S&P 500 had remained above its 50-day line for more than 130 consecutive days, the second longest streak this century. It was only a matter of time before the market acknowledged the law of gravity, and this remarkable run came to an end. If we look at the chart, the top panel shows the S&P 500 line, and the red dots mark periods when the index stayed in an extended short-term uptrend. Interestingly, after such long bullish runs, a short-term correction usually followed, but in most cases, the market later resumed its upward trend. So, should we worry? We remain data-driven in the Institute, and we believe that our market signals usually lead the news, not the other way around. As long as our system of indicators, those tracking the health of the economy and corporate earnings, remain positive, we focus almost entirely on our quantitative signals. They simply work better than all that media noise. And what do we see now? The US economy is still growing at more than 4%. The earnings season is over, and once again, corporate results have beaten analysts' expectations by a wide margin. If you look at the chart, you can see that the economy, corporate earnings, and stock prices move closely together. With both GDP growth and earnings remaining strong, stock prices are well positioned to deliver further gains. By the way, yesterday we got Nvidia's results, and it seems the market welcomed the latest earnings report from the world's largest company. Nvidia's third quarter revenue came in at $57 billion, well above analysts' estimates of $55 billion. That's more than a 60% increase year over year. On top of that, Nvidia's CEO Jensen Huang fired up sentiment even more, saying that sales of Blackwell processors are reaching unprecedented levels and that Nvidia's problem isn't making profits, it's being able to handle those record-breaking demands. It's hardly to find any bearish arguments in that, and as a result, Nvidia shares rose more than 3% in after-hours trading. Finally, let's take one more look at the current correction. Right now, if we look at the chart, we are about 8 months past the last 20% drawdown. The current trajectory looks strikingly similar to past S&P recoveries in 1998, 2018, or 2020. Those who've followed our previous videos will recognize this chart. We've been pointing out that 7 to 8 months after a 20% correction, markets typically enter a consolidation phase. In our view, as long as the market remains above the 100-day moving average, this looks like a classic healthy correction, a buy the dip opportunity, if you will, rather than the start of a new bear market. Looking beneath the surface, we see several positives. First, this still appears to be a rotation among sectors, not a market breakdown. Second, the correction has flushed out excessive optimism and crowded positioning, which is often a healthy reset for future gains. And third, the strong earnings from the Magnificent Seven show that fears of an AI bubble remains premature. So while short-term volatility may continue to generate fear, we believe that nimble investors are using this environment to add high-quality stocks with attractive risk-return characteristics to their portfolio. Stay tuned for more market updates and have a great week ahead. Cheers!